Namaste students. In the previous video we have discussed about barter system, then we have discussed about the drawbacks or limitations or difficulties of barter systems. Now in this video we are going to discuss the next topic, meaning of money. Students, you know that money is anything and which is generally acceptable as a means of exchange and at the same time acts as a measure of value and as a store of value. Or we can say that money is a matter of four functions, because whatever we have discussed in barter systems that completely whipped out by the money, because money we can use as a medium, money we can use as a measure, money we can store, or money can be used for the future payment also. So that is why here it is said that money is a matter of four functions: a medium, a measure, a store, and a standard of deferred payments. After that, next you see here our Indian monetary system. Students, you know our Indian monetary system presently it is controlled by the RBI. The whole monetary system in India is managed and controlled by the Reserve Bank of India. And India, the rupee symbol means, you know, every country there have a separate currency and they have separate symbol. In our country, our currency is called rupee, and this is actually regarded as the standard money. Students, this is the symbol of RBI. And one thing you should remember here, that is rupees 1 note and coin are minted by the RBI on behalf of the government. Means all the currency notes and coins except 1 rupee and 1 rupee coin all are issued by the RBI. Only the 1 rupee note and coin is minted or issued by the government of India. That is one department is that is Ministry of Finance. After that, next here now the most important thing is that what is the supply of money. Supply of money refers to total quantity or stock of money available in the economy at a particular point of time. Suppose in a year, what is the money available in the economy? That is actually money supply. And if we see the components of money supply, there are two components we can see. These two components, one is currency held by the public, means it consists of the coins and paper currency held by the public, mean whatever the coins and paper currency are exist and which is held by the public, that is one component. And second component is that what is net deposit, net demand deposit held by the commercial bank. These are the actually deposit which are payable on demand, and this can be withdrawn at any time. The bank provides check facilities also, because students, you know, the people they deposit their money in bank and whenever they need they can withdraw, and they can withdraw that money at any time, and they also can transact by the use of check also. So here these are the currency coins, these are the currency notes. In this way our the total money supply we can find out. Next, here see the Reserve Bank of India. We know that in India the whole monetary condition controlled by the Reserve Bank. So to measure the money supply, means in a particular point of time how many money are exist in the economy, to know about that the RBI issued or RBI use four measures, four alternative measures. So that is called, one is M1, and second is M2, and third is M3, and fourth is M4. So M1 means C plus DD plus OD. Here C means currency, D means demand deposits, and OD means other deposits, and M2 equal M1 plus saving deposit with post office saving banks. M3 means M1 plus net time deposits with banks, and M4 actually M3 plus total deposits with post office saving organization and excluding national saving certificate. So students, here you should remember that four measures which is used by the RBI to measure the money supply of a country: M1, M2, M3 and M4. So here in M4 one thing is given, that excluding national saving certificate. So what is excluding national saving certificate? So here see, national saving certificate it is given here. National saving certificate means, which is also known as NSC, is an Indian government saving bond and primarily used for small saving and income tax saving investment in India, and it is a part of postal saving system of the Indian Post. So here it is given the condition why it is invest in NSC, because profit is more and which is earned by the depositors or investor. So here one thing is given, that why it is not included. You see, whatever the four measures we have already got, that is M1, M2, M3 and M4. So among these M1, M2 and M3, these are more rigid form, but here M4 is not more rigid, means which is not liquid, which we cannot convert it directly to money. So it takes time. Here also one reason is that the maximum deduction permissible is 1 lakh, but there is no such limit for investment. An investor can invest any amount as much as 1, means in NSC he can invest the money, but whenever he need, he cannot withdraw that money directly. It takes time, so it is not more liquid. But M1, M2 and M3, these are more liquid forms. Next, approaches of money supply. Next topic is approaches of money supply. There are two approaches regulating money supply. They are as follows. Already we have discussed that M1, M2, M3 and M4. So if we see the traditional approach means money supply according to this approach includes coins, currency, notes and demand deposits. So M1 and M2, it is called the traditional or narrow money. And if we see the modern or broader approach, that is M3 and M4, so according to this approach, money supply includes coins, currency, notes, banks demand deposit, time deposit with banks, financial assets such as deposit with non-banking financial institutions like UTI, post office saving, bills, bonds, or all are actually come under a modern or broader approach. Here remember that this gradation, narrow or broad, that is a traditional or modern approach, in decreasing order of liquidity, because M1 is most liquid and easiest for transaction, whereas M4 is least liquid. So that is why NSC, that is not come under the M4 of the money supply. Why? Because that is not more liquid. So next topic, money multiplier. This is very important. What is money multiplier? So money multiplier, you see, money multiplier or deposit multiplier measures the amount of money and that the banks are able to create in the form of deposit with every unit of money. It keeps in reserves and it is calculated as the formula is the money multiplier is this. Money multiplier equal 1 by LRR. LRR means legal reserve ratio comprising of cash reserve ratio and statutory liquidity ratio, SLR. So students, remember that whatever the money is deposited by the public in bank, so bank actually what do with this deposited money? So they can increase their money or they can multiply their money. How? Because by giving the loan to the public. So here one remember that whatever the money is deposited in the bank, all the money is not given as a loan to the public. One part they are reserved as a cash with the central bank, and some part they kept themselves as a reserve, that is called LRR. So here you should remember that higher the value of LRR, lower is the value of money multiplier, and less money is created by the banking system and vice versa. Students, here this line. So here it is said that if the legal reserve ratio means whatever the money is reserved by themselves, means the bank keep with themselves, and cash reserve ratio means which money is reserved in the central bank. So if this value of these two reserve is more, then how they will able to give more money to the public as a loan? Definitely no. So that is why it is said that if LRR and CRR is more, then definitely money multiplier it will be less, or it is vice versa. So here one example is given here. By this example you can understand how money is multiplied. So here you see, calculate the value of money multiplier and also find the total deposit created. If there is an initial deposit of rupees 1500 crore and LRR is 15%, means from the 1500, 15% only it will be LRR. So if we calculate in this way, then here we will get, that is 10,000 crore. So means from the 1500 the money is multiplied up to 10,000 crore. So next here the important point is given. What is the high powered money? High powered money means what? High powered money means it is a consist of currency held by the public and reserve of commercial bank, includes vault cash and banks deposit with RBI. Means if we talk about the high powered money, then definitely we have to talk that high powered money includes currency held by the public plus reserve of commercial bank. Here it is said that including vault cash. Vault cash means, here it is given, vault cash means on hand, kept on hand in a depository institutions, vault to meet day-to-day business needs such as cashing checks for customer, can be counted as a portion of the institution required reserve. Means vault cash means whatever the money is kept by the commercial bank with themselves to meet the to give the customer, when customer will come to bank to withdraw their money, if money is not available, from where they will keep. So definitely they have to keep some cash as a reserve, that is called a vault cash. So here high powered money means in a particular time, I mean in a year, whatever the currency held by the public and whatever the reserve of commercial bank, all this together come under the high powered money. So students, this is all about the money, supply of money, high powered money, and how money is multiplied. So in the next video we will discuss about the commercial bank, its functions and money creation. So thank you.